What's leading to this rally when we're looking at financials? Is it simply the idea of rate cuts, or is there some other factor here?
I think there's a combination of factors, Frank, but rate cuts are certainly front and center. A steeper yield curve is very positive for lenders. And when you think about it, Frank, you got to go back 20 years where we had a Fed funds rate at over 3% with a positive slope curve of 75 to 100 basis points. We're not there yet, the 3-month and a 10-year. But if the Fed cuts once or two more times going into June of next year, we could see that type of yield curve. So that's been the main driver. But second, it's also the deregulation that this administration has brought to the banking industry. And that has also been another factor playing into this. And third, the capital markets business in 2025 was very strong, which really led to the strength in the money center banks and the investment banks.
You know, in the last couple of quarters, we've seen very strong trading revenues and outcomes for a lot of the big banks, a lot of that due to the volatility. However, we seem to be calming down a bit going into the new year. Do we need to see, or do the banks need to see volatility to continue to see those kind of revenues? Or are there other parts of the business you expect to accelerate in the new year? A lot of people look at the IPO market possibly picking up, and there is some backlog due to the government shutdown. So early on, we'll more than likely see it. But what are some of the tailwinds for banks that maybe are a little bit under the radar?
There's a couple of things, Frank, and you put your thumb on it in the capital markets business. Now, volatility is always good for trading. And if it's less volatile, maybe the trading numbers come in a little less than expected. But on the investment banking side, the ECM business, equity capital markets, which was where the IPO business sits, the initial public offerings, we anticipate that the initial public offerings could have a strong first quarter of next year, particularly because of the government shutdown this year in the fourth quarter, pushed, I think, a handful or a number of those IPOs into the first quarter. The advisory business, that's M&A. This administration is very open to supporting industries consolidating, therefore, not just in the banking industry, but all industries. But the other part of the equation is lending. I think you're going to find that lending is going to pick up. The nominal GDP number yesterday, if I recall correctly, was over 8%. Now, lending, going back 75 years in this country, when you compare the growth of nominal GDP to bank lending, it's about a 1-to-1 relationship. So loan growth could accelerate. That's the big surprise potentially in 2026.
All right, so you see the potential for loan growth acceleration. I also want to talk to you about M&A. I'm thinking Comerica, I'm thinking Synovus and its merger. Are you expecting to see more of that? And are there certain regions that are more likely to see this M&A? Are there certain lines of business? Because everybody's been talking about M&A, but not really the rationale behind it. Like, what's going to make a big bank want to acquire a smaller bank?
Yeah. Frank, it's a good question, and bank M&A has been going on our entire careers. And if you go way back to the early 80s, we had about 18,000 banks and thrifts in this country. We're down to about 4,300. And so that trend it's not linear, but it goes in peaks and valleys, and we're currently entering a peak period. Last year, or 2025, M&A was very strong in banking. We expect it to remain that way in 2026. Now, we haven't seen many big deals. You mentioned already the Comerica Fifth Third deal, which was a big deal and a very good deal for the combined companies, in our opinion. The Synovus Pinnacle deal was a big deal, but that's a merger of equals, as they call it, and the market didn't react favorably to that transaction. But we should see more deals because of economies of scale. To your question, why do they do it? For economies of scale. And we anticipate you'll see more deals because, again, this bank regulatory environment is very supportive of bank M&A. For example, in the last administration, it took 12 to 15 months to close the deal. Now the deals are closing in about 4 to 5 months, which is very positive for M&A activity.
All right, Gerard, no, it's a shock. We haven't said the words artificial intelligence yet during this whole interview. We talk a lot about the fintechs and some of these other companies getting into prediction markets and things like that. Are banks, are they should they be concerned or in any way about real disruption from some other players trying to enter their space?
We've been hearing about the disruption in banking for decades, and the banks are still here. And the banks are, according to the FDIC, in the third quarter, the banks reported record profitability. So the banks have been combating disruption for decades. We expect them to embrace AI. They're using AI. Bank of America, Brian Moynihan, their chairman and CEO, is a big believer in it. And I would say that AI, artificial intelligence, will be implemented and used throughout the banking system to make it more efficient and also potentially to be able to allow it to produce or grow revenues a little faster. But I think the initial thrust for AI in the banking industry is to improve efficiencies and make the industry more profitable.